that's what I find encouraging, is that I think Bitcoin's going to really find its identity. I was also, just because I was curious, looking up Google Trends. How popular is Bitcoin right now? And it's at its lowest level over the last 3 to 5 years. And so I think Bitcoin is going to really grow into a natural, truthful identity on the back half of what has to be an incredible amount of stimulus from sovereigns. At the end of the day, to me, Bitcoin is priced on future expectations of fiat liquidity, period. Bitcoin is the antithesis of fiat. Fiat has no supply cap. Bitcoin is finite. Fiat can be censored. Bitcoin can't. Fiat cannot be audited. Bitcoin can be audited by anybody. And so Bitcoin is the best expression of fiat. And so if there's tightening of fiat liquidity, then Bitcoin is going to be the smoke alarm that shows us that.
Jack Mallers begins with a straightforward statement that is still misinterpreted by many investors. Bitcoin does not follow stocks or bonds when global risk markets start to falter. First, it moves. Bitcoin functions as a smoke alarm for global liquidity since it is the only genuinely free, uncensored, round-the-clock market in the world. Bitcoin is the first asset to respond and scream when fiat liquidity shrinks. Mallers uses his U.S. liquidity index to illustrate the significance of this. One of the tightest liquidity environments we've seen in years is indicated by the index's over a 10% decline over the last 6 months. Many investors have been unprepared for this tightening, particularly in light of the ongoing shifting and conflicting political narratives surrounding money, stimulus, and financial stability.
We could be, listen, could Bitcoin go to 85, 80? Probably. But I think there's two things. There's a really healthy cleanse of narratives within Bitcoin. I think that there was a lot of, the narrative was ETF institutional demand. Well, a lot of the ETF flows are the basis trade, is, arbitraging futures with the ETF. And then there was the Bitcoin treasury narrative, which we can talk about as I'm the CEO of 21. We're not a treasury company. We think we're substantially different than that. But there was this idea that institutions were gaining exposure to Bitcoin through these Bitcoin securities, and that there was an MNAV premium to that. And a lot of that's unwinding, which I think is very healthy. And so I think we'll find a bottom when the market realizes that Bitcoin doesn't trade in 4-year cycles, and that a lot of the institutional narrative was a little bit overblown. But right now people are freaking out. Like, oh my gosh, these institutions, they're unwinding from their ETF positions and they're unwinding from Strategy's MNAV trade, when in reality, I don't think it was ever really there at the size and scale that it was purported to be and that the narrative conveyed. And that Bitcoin doesn't operate on 4-year cycles like horoscopes, like it doesn't align with the stars. It operates on expectations of fiat liquidity, which is what it was designed to do. And so I think once the market relaxes, calms down, then we move on to this next chapter of liquidity. I mean, we're hitting the bottom of the liquidity cycle. That's what I would say here on Kitco. I'm not going to call any Bitcoin bottoms, but the Fed has said they're going to have to start expanding the balance sheet. Just for context, peak Fed balance sheet, we're at $9 trillion. Now we're close to $6 trillion. That is an insane amount of tightening. Never have we tightened more. People often say, well, if China and Japan sold all their US treasuries, then we'd really be in trouble. I think broader markets in risk are selling off, just generally speaking. Bitcoin tends to lead that because Bitcoin tends to be one of the only accurate smoke alarms for fiat liquidity we have left in the world. And I hold the thesis that that's because Bitcoin's the only truly free market that we have left in the world. But what I think markets are going through right now is really trying to digest what has become a complicated liquidity situation. So, I actually, as preparing for this show, I pulled up my US liquidity index. The US liquidity index that I look at is down 10%, a little over now, over the last 6 months. So I think the story is this Trump administration came in, they campaigned on lots of liquidity, reindustrialization, lots of GDP growth. And that narrative was a little confusing with Elon Musk and Doge, and that Elon Musk was going to send us into austerity by running the US government like a lean startup. And the markets then front ran liquidity. You saw Bitcoin separate and front run what the markets assumed to be more liquidity coming, that there was going to be a truce with China, tariffs were going to be a little bit more mild than they were advertised to be, and that the US would find a way to work with the Federal Reserve and reindustrialize this country and print lots of money to make whole on the promises of the campaign. And I think that hasn't happened. Most specifically that I want to highlight is in September, the US government ran a $200 billion surplus. So that is an annualized surplus of over $2 trillion. And then in October, the government shut down. And so this has been one of the tighter liquidity periods for markets generally. I think the combination of AI, this administration, and the lack of liquidity follow through markets are just trying to wrestle with. And so Bitcoin is correcting back towards where it was before this administration got going, because it's unclear where the liquidity is going to come from and when it's going to come. At the end of the day, to me, Bitcoin is priced on future expectations of fiat liquidity, period. Bitcoin is the antithesis of fiat. Fiat has no supply cap. Bitcoin is finite. Fiat can be censored. Bitcoin can't. Fiat cannot be audited. Bitcoin can be audited by anybody. And so Bitcoin is the best expression of fiat. And so if there's tightening of fiat liquidity, then Bitcoin is going to be the smoke alarm that shows us that. And so I actually put out a post on X over the weekend where I said, gold making new highs this year shows us that governments and central banks have to print, but Bitcoin falling from highs right now shows us that they might have a liquidity crisis before they're forced to. And so I think the two assets play different roles, and that Bitcoin is a very accurate smoke alarm of where liquidity is today, rather than the gold market is sniffing out where this is inevitably going, right? And there's all sorts of stimulus, whether it's Fannie Mae, Freddie Mac, a housing crisis to be declared in 2026. So I see this as a buy the dip opportunity. The way to monetize a currency failure is to not bet that the stock market's going to go down 50% like Michael Burry and have your fund shut down. The way you do it is by owning a better currency than the dollar, which would be something like gold and Bitcoin. So this is a buy the dip opportunity for me. I think liquidity has to come physically. There's no other option. And this is just a mere reaction to the lack of follow through from the administration.
The financial system might fail if liquidity doesn't return. Normally, policymakers wouldn't take action until a significant collapse occurred, such as a bank, the repo market, or the stock market crash. In actuality, though, they already know how this tale will conclude. They have experienced multiple liquidity problems in the past, including those in 2008 and 2020. Liquidity will therefore reappear. The true question is whether action will be triggered by another panic attack or meltdown, or if stimulus will come before a crisis arises. Currency depreciation and a revaluation of assets like gold and Bitcoin are the results in either case. It's interesting to note that according to Google Trends data, public interest in Bitcoin is currently at one of its lowest points in the previous 3 to 5 years. This could be a sign of opportunity for those who are paying attention.
But there's two real core narratives that the market needs to digest in regards to the Bitcoin ETFs. One is this basis trade. So you're seeing large banks like Goldman Sachs or trading firms like Susquehanna, what is reported as massive Bitcoin positions. And maybe they are taking a directional position on Bitcoin, but the reality is they're running this basis trade where they're able to buy the Bitcoin spot ETF and sell the futures on the CME and capture a spread. And if that spread is returning them more than Fed funds, then that is the equivalent of better risk-free returns for these capital allocators. And so what looks like massive ETF inflows is actually also realized as sell pressure on the futures. And so there's been a misguided narrative that Goldman Sachs cares about Bitcoin just as much as I do. I don't think that's true. I think that they're trading a spread and they're making these markets more efficient. However, it is true in other circumstances, like we've seen Harvard. Harvard has one of the largest Bitcoin positions of any endowment in the world. I think it's one of their largest ETF positions within the endowment, period. Now, those positions are real. And the really important part, Jimmy, is there's been more Bitcoin OGs of folks that have been sitting on thousands of coins for over a decade that have been realizing profit. And so actually more than 50% of Bitcoin that has been acquired is underwater right now because there's been a massive rotation of a lot of folks. Almost think of it as an IPO moment where lots of early investors are realizing some liquidity and some gains. And a lot of the folks like Harvard, like firefighter pensions, they are actually using the ETF to soak up a lot of the liquidity. So I would say it's both. Part of the outflows that you're seeing is because the basis trade is no longer returning more than Fed funds. And you see this kind of cyclical wind and unwind, wind and unwind. And you can track that just by how profitable the basis trade is. But what's encouraging is all the endowments and the pensions that are buying for the long term and treating Bitcoin like a hedge against future fiat debasement. The really cool thing about this is if you have a low enough time preference, none of this matters. You mean the financial system is going to collapse if they don't provide the liquidity to keep it going. And we all know that. The question is, are we going to need a bank collapse? Is someone going to have to blow up in the repo market? Is the stock market going to have to go down 20% like during Liberation? I mean, Liberation Week, where we all felt so awfully liberated, I mean, everyone thought it was a Great Depression. And then markets rallied to all-time highs only weeks afterward. And so the question is, it's a when, not an if. Now, short-term speculators, that's not me, that's not my game. What I do think is important is that markets really flush out a lot of the narratives that are maybe inconsistent with the truth. And that's what I find encouraging, is that I think Bitcoin's going to really find its identity. I was also, just because I was curious, looking up Google Trends. How popular is Bitcoin right now? And it's at its lowest level over the last 3 to 5 years. And so I think Bitcoin is going to really grow into a natural, truthful identity on the back half of what has to be an incredible amount of stimulus from sovereigns. We're living through a sovereign debt crisis. I mean, at the end of the day, that's the problem, is that these sovereign nations are in way over their head. And gold is sniffing that out. We're going to have to reprice the world around us in a significantly weaker dollar. And Bitcoin is taking us along that journey. But in part of you're exposed to more volatility with Bitcoin. You're exposed to more of the extremes, but that's to both the downside and the upside. And so, to each their own. I prefer owning the best performer. And so these are buy the dip opportunities for me. And
according to Jack Mallers, Bitcoin is a highly effective signal for comprehending global liquidity rather than just another asset. Since Bitcoin is one of the few remaining completely open, uncensored markets, it usually reacts first when larger markets sell off. It shows us in real time when the system is tightening, acting as a sort of smoke alarm for fiat liquidity. Mallers claims that within the last 6 months, the U.S. liquidity index he monitors has dropped by over 10%, demonstrating how tight things have gotten. Mallers notes that the price of Bitcoin is not determined by random cycles or transient patterns, but rather by expectations of future liquidity. Bitcoin is a natural hedge as liquidity tightens, since it is limited, auditable, and resistant to censorship, unlike fiat currencies. Bitcoin is an early warning system because it responds to sudden liquidity stress, whereas gold represents the central bank's inexorable need to produce money. Mallers believes that the return of liquidity, stimulus, and possible rate cuts, along with the conclusion of quantitative tightening, are clear indicators that the markets are bottoming. In a world where fiat could continue to deteriorate, he contends that Bitcoin is positioned to prosper as the finest representation of the health of the financial system and a superior currency. Although the popularity of Bitcoin is currently lower than it has been in the previous 3 to 5 years,